Hey guys, welcome back. So as many of you know, Robinhood Stock recently IPO'd just a few days ago on July 29th, and shares have been on a wild ride ever since. Shares of Robinhood Stock initially fell in the first couple of days of trading before being lifted massively by a sea of retail investors. You can probably thank Wall Street Bets for that. However, despite the apparent success of Robinhood's IPO, there's actually a dark side to Robinhood that not many people want to talk about. In fact, the app that democratized investing for all by being the first to offer commission-free trading might not be as benevolent as you think. Now, before I talk about the dark side of the Robinhood trading app, I do have to talk first about the positives. For one, I think we all owe a great debt of gratitude to Robinhood for being bold enough to challenge the industry standard practice of charging commissions on stock trades. Personally, I remember the days when brokers like Fidelity would charge an entire $5 just to buy a stock, and this $5 was applied equally regardless of the amount of stock you bought. This meant that for trades even as small as $1,000, investors were losing 0.5% of their money up front. Multiply that by tens or even hundreds of trades, and that adds up very quickly. In fact, buying $50 of stock and paying a $5 commission would mean an upfront loss of 10%, just for the privilege of buying the stock. So make no mistake, when Robinhood burst onto the scene back in 2018 and started offering free trades, this was a huge win for retail investors. However, shortly after Robinhood gained popularity, many investors started wondering just exactly how does Robinhood make their money? We all know the saying, there's no such thing as a free lunch, and investors knew that Robinhood wasn't providing their service for free. However, even though Robinhood makes money by using sketchy practices like selling order flow, many retail investors felt it was a small price to pay for not having to pay exorbitant commissions on their stock trades. And on the surface, this does seem like a fair trade-off. For one, Robinhood makes very small amounts of money on each trade you make, and this fee was far less than other brokers were charging. Also, Robinhood's app is a lot easier to use than other trading platforms, which means first-time investors had a much easier time learning to trade. But even though Robinhood claims to offer commission-free trading, that doesn't mean that investors aren't paying for their trades. In fact, recent data shows that Robinhood makes, on average, $137 per user per year on their app. And while that might not sound that bad, consider this. The average account balance on Robinhood is only $3,500, which means that $137 fee represents a 3.9% loss for the average user, which is really bad. Most index funds that track the S&P 500 charge annual fees that are well under 0.1%, which means you would have to have nearly $500,000 invested in one of these S&P 500 funds before you paid $137 worth of fees. So for investors who use Robinhood, this means that over a 30-year period, this 3.9% underperformance can cut your total returns in half. Yikes. But even though Robinhood has a history of sketchy business practices, that is not what I want to focus on in this video. Instead, I want to look at the unintended consequences of Robinhood's practices and show how, despite the fun, user-friendly interface, Robinhood's app is not built to benefit investors. In fact, I would go as far to say that if you are using Robinhood as your main broker, there's a very high chance you are drastically underperforming the market. And here's why. For one, taking away the penalty for trading has led to an increase in trading. This is not too surprising, and it does make a lot of sense. However, this increased trading does have a dark side. A study conducted by Professor Nagat Sabun of the University of Michigan found that a vast majority of an investor's gains came from only a small handful of trading days. In fact, investors who missed just 1% of trading days would have missed out on 95% of the gains. What this tells us is that constantly buying and selling your stocks raises your risk of missing out. But it's not only underperformance that investors have to worry about. Excessive trading can also result in higher taxes that can further reduce your gains. Keep in mind that long-term capital gains are taxed at a much lower rate than short-term, so waiting a year to sell your stocks not only means that the stock has longer to appreciate, but it also means that the amount you pay in taxes will be drastically lower. On top of that, capital gains from large stock sales can push you into higher income brackets where you will be forced to pay a higher marginal tax rate. But regardless of how you feel on these issues, there is the bigger question that needs to be addressed. And that is, do you want to support a company that preys on its customers in order to make money? Now, that might sound like a strong statement, but the fact of the matter is that the only way for Robinhood to keep growing is to get their customers, which is you, to buy and sell more frequently. This means that everything Robinhood does, from the design of its app to the types of services it provides, are all designed to trick you into trading more. This phenomenon has been called by many the gamification of stock trading. And the sad part is that it is working. In fact, in this chart from the New York Times, investors who used Robinhood traded 12 times more frequently than TD Ameritrade investors. On top of that, Robinhood investors tend to buy much more volatile and speculative assets, with the riskiest options contracts being traded 88 times more frequently on Robinhood's platform when compared to Charles Schwab. These practices of frequent trading and buying risky assets can both lead to massive losses for investors who choose to use Robinhood. But despite all of these negatives, if you still use Robinhood's app and you are convinced that the app is completely harmless, then don't take my word for it. Instead, you might want to listen to the words of Michael Burry. Burry is a prominent investor who has also had very strong criticisms for Robinhood in the past. During the height of the GameStop trading craze, Michael Burry became critical of Robinhood, tweeting out this statement: "The Main Street revolution is a myth. Zero commissions and gamified apps were designed to feed flows to the two most influential Wall Street trading houses." And this statement proved true when only a few short days later, Robinhood suspended trading of GameStop stock in order to protect their Wall Street clients, one of which was Citadel Securities, which, in case you were wondering, Citadel was the firm who loaned billions of dollars to the hedge fund Melvin Capital to help cover their losses from betting against GameStop stock. So it would appear that the app that democratized investing for all is actually not as benevolent as they want you to believe. And Michael Burry further highlights this point by adding that if retail is moving towards more trading and away from fundamentals, Wall Street owns that game. So now that you understand this and are no longer a mindless sheep trading in the Robinhood casino, what can we do about it? Well, personally, I completely sold off all of my stocks in my Robinhood portfolio and shut down my account last year. I noticed that even someone like myself who has over a decade of trading experience was not immune to their tricks. I was trading much more frequently on Robinhood's app than I ever did with other brokers. And when I reviewed my trades, I found out I was losing a lot of money. Also, I found Robinhood's account management and research tools to be severely lacking, which might be fine if you are trading with a very small amount of money, but this started to become a real problem for me as the value of my account grew. However, regardless of what you personally decide to do, there is another question that remains when it comes to Robinhood stock, and that is, what does the future hold for Robinhood stock? Well, this is where things actually take an interesting turn. Despite the overwhelming evidence that Robinhood is bad for its users over the long term, the sad reality is that many people will continue to use the app. And even though there are a lot of negatives for investors who choose to use Robinhood, that doesn't mean that Robinhood stock won't continue to go up. Facebook has a similar business model to Robinhood's and has been able to grow tremendously over the past decade by using the same shady tactics. Facebook uses notifications and all sorts of other tricks to trigger your brain into releasing dopamine. And this dopamine reaction is very similar to what happens when our brains are on drugs. So when you feel like you can't stop checking your Facebook account or your Robinhood account, that's not your own fault. It's by design. And just like Facebook wants to get you hooked on their product in order to advertise to you, Robinhood wants to get you hooked on their product so that you will trade more. However, despite the fantastic success Robinhood has enjoyed over the past years, there are signs that their business model might be in trouble. The idea of allowing new and inexperienced investors the ability to trade options with high levels of margin is leading to some very disastrous results. In fact, thanks to a glitch in Robinhood's app, one investor was able to rack up nearly $1 million of debt with just $5,000. And unfortunately, because of Robinhood's terrible customer service, this investor took his life before the issue was resolved. But even though this case became a national news story, it would appear that Robinhood has no intentions of stopping this business practice moving forward. There are dozens of additional stories of inexperienced investors on Robinhood losing hundreds of thousands of dollars by trading options. Take, for example, the story of Richard DeBotse. He began trading options on Robinhood with no prior experience in 2017 and even managed to grow his account from $45,000 to over $1 million in just a few short years. However, as of March of last year, he had lost nearly all of it, revealing his current account balance was only $6,000. Now, I know it's tempting when we hear stories like this to place all the blame on the investors for making what many of us feel like are rookie mistakes. But when it comes to these inexperienced investors, I do think that some blame needs to be placed on Robinhood. For one, proper financial education is very lacking in our school system, and there are a ton of smart people out there that simply don't understand how risky stocks can be. And two, Robinhood actually has a financial incentive to encourage people to take on more risk. Robinhood makes more money off of options trading than they do by selling order flow, which not a lot of people know. In fact, options trading accounted for 40% of Robinhood's revenue last year, compared to only 26% for selling order flow. And according to Massachusetts Financial Secretary William Galvin, Robinhood approved 600 people in the state of Massachusetts for options trading that didn't qualify based on even Robinhood's own standards. And this is just the people that state regulators were able to find. So it is highly likely that this number is much higher across the US. And in my opinion, this business model of encouraging inexperienced investors to borrow money they don't have to trade options is a recipe for disaster. In fact, this business practice is so toxic that Robinhood's CEO, Vlad Tenev, is trying really hard to change the narrative surrounding these business practices. In a recent statement, Vlad pushed back against critics of Robinhood by stating that we see evidence that most of our customers are investing for the long term. And while I can neither confirm nor deny this claim by Vlad, to me, this is simply an attempt to change the narrative. For one, we've already seen that long-term investors who simply buy and hold stocks don't generate any significant amount of revenue for Robinhood. Also, because of the lack of tools designed to help long-term investors, I find it very hard to believe that true buy and hold investors are choosing to use Robinhood when there are way better options out there. But instead of trying to guess Vlad's intentions, let's instead look at his actions. Most CEOs of companies who believe in their businesses tend to hold on to their shares and will even buy additional shares when their stock price drops. However, when looking at Vlad's recent trading history, we can see that this is not the case. When shares of Robinhood dropped on the first day of trading, Vlad took the opportunity and sold, selling 1.25 million shares of his Robinhood stock at a price of $36 a share. And the sad part for Vlad is that he would have resisted the urge to sell and instead held on to those shares for just a few more days, he could have doubled his money. But don't feel too bad for Vlad. With an 8% ownership stake and 710 million shares outstanding, Vlad still owns roughly 56 million shares. And that's not where the good news ends for Vlad. Robinhood has something that a lot of companies are jealous of, and that is young users. Young users are essential for a company's long-term success, and getting customers hooked on your product when they are young can lead to a lifetime of rewards. Also, with younger users avoiding more traditional forms of media, advertising to these younger users has proven much more difficult. On top of that, Robinhood can easily pivot to provide a bevy of other fintech products to its loyal customers. Other fintech companies such as PayPal and Square have seen massive success by making access to financial products easier and more convenient. And there's nothing stopping Robinhood from doing the same. In fact, Square recently bought buy now, pay later company Afterpay for a record $29 billion. And this sent Square stock rocketing higher by 10% when they announced the news. So if Robinhood starts to go this direction, then there could be substantial gains ahead for their stock. But at the end of the day, I believe Vlad Tenev is a CEO that cannot be trusted. And he is someone that I believe will say whatever it takes to shift the narrative in Robinhood's favor. Also, here's a fun fact for you. The day before Robinhood stock went public, Robinhood was fined $70 million by FINRA for harming customers with misleading information and system outages. So when it comes to something as important as your finances, I don't think Robinhood is a broker that deserves your trust. And if you want to invest the right way and build long-term wealth, it is essential that you find a broker that supports healthy trading habits. Now, if you are looking for a new broker to switch to, feel free to click on the link in the description and sign up for M1 Finance. M1 is an investing app and checking account that truly prioritizes long-term investors. All you need to do is pick the stocks you want and fund your account. And the cool part is that M1 will do the rest for you. So if that sounds interesting to you, click on the link below and sign up. Now, if you want to see the stocks I have in my personal investment portfolio, all you have to do is become a member of my Patreon. The cost is only $10 a month, and with that, that, you get a number of benefits, including full access to my portfolio, instant notifications whenever I make a trade, and access to a private Discord channel where you can chat directly with me and others about the stocks we discuss on this channel. So if you are not a member of my Patreon yet, make sure you head over there and sign up. Also keep in mind there is a limited time offer for the first 25 people who sign up, and those spots are going fast. So make sure you guys go over there and join. Well guys, that's all I have for you in this video. If you liked it, make sure to hit the like button and subscribe. And with that, thanks for watching.